Hello and welcome to this video on short selling. Today I'll be explaining how short selling works, key concepts relating to short selling, and what the term short squeeze means. So let's get started. So let's start by looking at the share price of Apple stocks over a 12-month period. Now, if an investor thinks that Apple is undervalued, then they would buy stocks in Apple. If then the share price increased, the investor would profit from the increase in value. Likewise, if the value of the share decreases, the investor would make a loss. It is clear that buying the stock allows an investor to be rewarded when the value increases. But how can an investor profit if they think the share price will decrease? Well, they can short the stock. But how does shorting work? To profit from the price of the share reducing, you need to be in a position that increases in value when the price of the share drops. To do this, you first borrow the stock from someone, most likely a broker. Once you've received this borrowed stock, you sell it in the market. As you have sold it in the market, you would receive a cash payment for selling this stock. Then, in the future, when you would like to exit this short position, you would rebuy the stock in the market and return it to the organisation you borrowed it from. Now let's run through an example with Apple. If Apple's share price is currently trading at $173, you could borrow a stock from the broker and sell it in the market. You will therefore immediately receive $173 for that sale. Then at some point in the future, you would need to exit the short position. If, for example, the price drops to $153, you can repurchase the stock in the market for that price, and then return the stock back to the broker. In this example, you would therefore make $20 in profit. Yay! Because the price that you sold the Apple stock, which was $173, the price you repurchased it at $153, is a difference of $20. Likewise, if the share price had increased to $193 and you exited that short position at that time, you would make a loss of $20 in this case, as the price you have repurchased the stock for is $20 higher than the price you originally sold it for. There are a few points to note relating to short selling. Firstly, the short seller would need to cover any cash flow payments from the asset when borrowing. For example, if there is a dividend on the stock, the short seller would need to make the equivalent payment to the lender. So theoretically, if there has been a large dividend payment, the short seller could still make a loss on a position, even if the price of the asset has gone down. Secondly, a lot of lenders, such as brokers, would ask for collateral as a condition to borrow. The purpose of the collateral is to ensure that the lender will receive the amount due to them when the short position is closed. If the price of the borrowed asset increases, the lender will likely ask for the short seller to provide more collateral through something known as a margin call. If the short seller can't provide the collateral, they would be asked to close the short position and return the borrowed asset. Finally, there may be a charge to borrow the asset, similar to being charged interest if you borrowed money from a bank. The cost to borrow will tend to be larger for short positions that are open for a longer period. A popular term used in short selling is a short squeeze. But what does this mean? Let's start by displaying the share price of GameStop in January 21. A short squeeze begins when the share price increases by a significant amount. On the 26th of January 2021, the share price of GameStop increased by 93%. As a result of the large increase, many investors who had short positions decided to exit their position. To exit the position, they need to rebuy the stock, which increases the demand for the stock. As demand for the stock increases, this causes the price of the stock to increase even more, resulting in more investors closing their short position. This loop, where short sellers exiting leads to events where more short sellers need to exit, is known as a short squeeze. In the GameStop scenario, the following day, the price of the share increased by 135%, with the share price more than tripling over those few days. In February, when the short squeeze ended, the share price reduced significantly. Thank you for watching this video. I hope you now have a better understanding of short selling. But it's bye for now.